I think we're very near the edge of playing with fire.
In one of his last ever public interviews, legendary investor Charlie Munger warned about a $61 trillion storm that has been brewing in the U.S. stock market for nearly 2 decades that may soon be finally making landfall. This problem has continued to grow worse, with the stock market up over a combined 50% since the start of 2023. What does this mean for people with money in the stock market? Well, Munger thinks it could very well result in the dreaded lost decade, a 10-year period of time where returns are flat or even negative after factoring in the devastating impacts of inflation. An idea that America, similar to Japan in the 1990s, is going to have a decade-long period of economic stagnation where the stock market provides basically no real return for investors. It's not just Charlie Munger sounding alarm bells. Goldman Sachs even recently put out a note saying they believe the big return years for the stock market are a relic of the past. Instead, Goldman Sachs is forecasting the S&P 500 will return just 1% annually after factoring in inflation for the next 10 years. This would imply a lost decade and one of the worst stretches for U.S. stocks, dating back generations. What I want to explore in this video is if there is any truth behind these dramatic and alarmist headlines. Interestingly, we have seen prominent investors like Warren Buffett and Ray Dalio actually agree on the idea that stock returns over the next 10 years will likely not be anywhere near as good as the prior 10. Let's break down the arguments they are making and see if this is a real possibility over the next decade. Make sure to stick around to the end of the video because I have a special treat from Charlie himself for those that watch this entire video. The concept of a lost decade is nothing new. Take a look at this chart of the U.S. stock market over the last 90 years. The stock market is commonly referred to as the greatest wealth generating tool in the entire world. This is because over the long term, the stock market in the U.S. has averaged annual returns of 10 to 11%. However, that only tells part of the story. There have been multiple periods of time where stocks went a decade plus with flat or even negative returns. In August 1929, the S&P 500 hit a peak of 31. The market then went on to crash nearly 90% as the roaring 20s in the stock market quickly became the dirty 30s, as investors saw their wealth vaporize nearly overnight. It wouldn't be until the year 1954 when the stock market finally reached levels hit at the peak of the 1929 bubble, 25 years of flat returns for investors. This is far from the only difficult stretch the stock market has had to endure. The S&P 500 hit 103 in January 1969. The U.S. economy during the 1970s was marked by significant challenges, leading to what is often called the stagflation era, a rare combination of stagnant economic growth, high unemployment, and soaring inflation. It would take a full decade until the S&P 500 would hit 103 again, and finally remain above that level moving forward. These lost decades aren't just a relic of the 20th century. In August 2000, the S&P 500 surpassed 1,500 during the peak of the dotcom bubble. Investors were excited about the prospect of how the internet would revolutionize society and the economy. As a result, investors' enthusiasm pushed up stock prices to sky-high valuations. Tightening monetary policy and failure of these companies to meet the unrealistic expectations led to the bubble bursting. It would take until 2007 for the stock market to recover to levels reached at the peak of the dot-com bubble. However, this recovery was short-lived as the dot-com bubble soon gave way to the GFC. Stocks would plunge again, and it would take until 2013 for the S&P 500 to return to levels hit during the peak of the dot-com bubble. What investors like Charlie Munger, Warren Buffett, and Ray Dalio are warning of is that with the S&P 500 at incredibly high levels in 2025, and stocks such as the Magnificent Seven trading at what appear to be high valuations, there is potential that investors today are getting caught in the same trap. A trap that has been repeated time and time again. Investing at the all-time highs only to experience a prolonged period of stock market weakness. Here is Charlie Munger in one of his final interviews talking about this exact problem.
Expect the next 10 years to have lower returns in the equity markets than the last 10? He doesn't give us an idea why?
The answer is yes.
And could you give us a hint as to why that might come to pass?
Yes, because so many people are in it and the frenzy is so great and the systems of management, the reward systems are so foolish that that I don't think it's going to work at all. I think the returns will go down, yes. In real terms, the returns will be lower.
This is obviously a very bold claim by Charlie Munger, but there is something important that needs to be pointed out. Charlie believes real returns will be much lower. This is a very important nuance in understanding the debate around the potential for a lost decade in the stock market. You need to know the difference between so-called nominal returns and then what is referred to as real returns. Here's a simple example to demonstrate. In 2024, the S&P 500 generated a nominal return of about 25%. The difference between the nominal return and the real return is the impact of inflation. During this time, inflation was approximately 2.6% based on the Consumer Price Index. After factoring in the impact of inflation, the real return was more like 22%. It is incredibly important to factor in inflation when thinking about stock market returns. The whole reason people invest in the first place is to be able to grow their money faster than inflation is pulling them back. Remember how I mentioned earlier that investors in the US stock market had essentially flat returns between the year 2000 and 2013? Well, that 0% return was in nominal terms and didn't even take into account inflation. Between the year 2000 and 2013, the United States economy experienced cumulative inflation of approximately 35% during that time period. Put another way, if something would have cost $100 in 2000, that same item would have been $135 in 2013. Going back to our calculation of real return, this 35% inflation rate resulted in that 0% nominal return over the 13-year period to fall to a real return of negative 26%. This example demonstrates the devastating impact inflation can have on returns for investors and hits at the core of the argument Charlie Munger made when he warned about the future real returns for the stock market. Throughout their career, Munger and his business partner, legendary investor Warren Buffett, were able to generate investment returns well in excess of 20% annually, more than double the long-term average of the stock market. Buffett's investment process, until recently, was a closely guarded secret. That is, until now. As a thank you for watching this video, I went through countless hours of Buffett's interviews and writings to compile the exclusive Warren Buffett Investment Checklist. This document is my free gift to you for supporting this channel. Make sure to download your copy for completely free in the description of this video, because it's my goal to make you a better investor by studying the world's greatest investors. Let's get back to the video. The anticipation of structurally higher inflation is the first key element to this lost decade debate for the stock market. Here's why Munger thinks inflation will be higher over the next decade, and how this could keep real returns flat or even negative.
What do you think of the combinations of quantitative easing and large fiscal deficit, and where are they going to lead us?
Well, there I've got a very simple answer, and that is it's one of the most interesting questions anybody could ask. And we're in very uncharted waters. Nobody has gotten by with the kind of money printing we're doing now for a very extended period without some trouble. And I think we're very near the edge of playing with fire.
That interview was filmed back in 2020. At that time, the United States was in the middle of the largest money printing effort in the history of the world. This chart is the supply of money in the U.S. economy. As we can see here, the supply of money in the economy was increasing at a relatively consistent rate throughout the 80s, 90s, 2000s, and 2010s. Just this consistent and linear growth in the supply of money was enough to get people worried that at some point the U.S. would eventually have a massive wave of inflation. However, everything changed in 2020. In order to prevent a widespread financial collapse, the U.S. Federal Reserve took truly unprecedented actions. This, combined with drastic steps by the government to support the economy, led to trillions of new dollars getting printed. This massive money printing by the U.S. Federal Reserve caused the money supply to go from growing linearly to growing more like exponentially. Here's why Charlie Munger was worried that all this money printing could have devastating impacts when it comes to inflation. To quote the famous economist Milton Friedman, inflation happens when there is too much money chasing too few goods. While that may sound like a complicated concept, trust me, it's actually very simple. Let's break down how inflation works using a simple supply and demand graph. This line here shows the demand for a particular good or service. Let's use the example of renting an apartment in your city. The demand line represents the number of people looking for a place to rent in that area. It also shows how much they're willing and able to pay for rent. Now this line here is the supply line, which represents the number of apartments available to rent in the area. The point where the demand and the supply lines meet shows the current price for renting an apartment. In 2020 and 2021, the U.S. government and the Federal Reserve took big steps to support the economy. These included sending money directly to households, increasing unemployment benefits, and pausing payments on certain types of debt. At the same time, the Fed lowered interest rates to record low levels. These actions injected a lot of money into the economy, which shifted the demand line to the right. This means people had more money to spend, increasing demand. On this graph, we can see that the supply and demand lines now meet at a higher point, showing an increase in prices. This is a simple way to explain what causes inflation. When there's more money available, people spend more, which raises demands for goods and services. If the supply doesn't grow at the same pace, prices go up. In other words, inflation happens when there's too much money chasing too few goods, leading to a steady rise in prices. This argument for structurally higher inflation moving forward is only part of the concern around a potential lost decade for the stock market. Probably the single biggest reason the likes of Warren Buffett, Ray Dalio, and Goldman Sachs are worried about future stock market returns comes down to one thing: valuations. As you can see here, the P/E ratio of the S&P 500 is a big predictor of future returns for the stock market. As a general rule of thumb, the higher the current P/E ratio, the lower returns investors can expect moving forward. As you can see here, the opposite is also true. When P/E ratios are low, future returns tend to be higher. The current forward P/E ratio of the S&P 500 is roughly 23 times as of the making of this video. Based on history, the current P/E ratio of the stock market implies annualized returns of about 0% for the next decade. A large reason why the valuation of the S&P 500 is so high has to do with the so-called Magnificent Seven stocks. The Mag 7 refers to a group of the largest and most influential U.S. technology and growth companies. These stocks are often highlighted because of their significant impact on the overall stock market, particularly the S&P 500 index. The group consists of Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla. Here are their current forward P/E ratios from lowest to highest. Alphabet at 21 times, Meta at 24 times, Amazon at 31 times, Microsoft and Apple both at 32 times, Nvidia at 46 times, and Tesla at 122 times. As wild as it sounds, these 7 stocks alone account for nearly 1/3 of the entire S&P 500 index. The S&P 500's price-to-earnings, or P/E ratio, is skewed by these larger stocks because it's weighted by each individual stock's market cap, which means that bigger companies like the Mag 7 make up a larger portion of the index. As a result, these high P/E ratios pull up the average for the whole index. If I were to exclude the Mag 7 stocks from the calculation, the forward P/E ratio for the S&P 500 would go from the 23 times P/E it is currently trading at to more like 19 times. Let's go back to our chart of P/E ratios and subsequent annualized returns over the next 10 years. At a forward P/E ratio of 19 times, history would tell us that we could expect mid to high single digits annualized returns over the next decade. While this is short of the long-term U.S. stock market return of 10%, it is still far more attractive than the 0% return at the higher 23 times P/E ratio. Keep this in mind next time someone tells you the stock market is in a bubble. If we exclude the Magnificent Seven stocks, the 19 times P/E ratio for the rest of the S&P 500 is much closer to the historical average of 17 times that it is traded at over the past 30 years. Ultimately, only time will tell how things play out. During these times, it can be helpful to remember the iconic Warren Buffett saying, "Be fearful when others are greedy, and be greedy when others are fearful." As promised, I have a special treat for you for making it this far in the video. Download the exclusive Charlie Munger's 11 Mental Models to Outperform the Market. This is completely free and only available at the link in the description of this video. I have spent hours putting this document together, and there is nowhere else on the internet that you can get this kind of information for free. Make sure to check it out because studying Charlie Munger and his mental models has significantly improved my life, and I'm confident it will do the same to you. Enjoy!